It didn't start with the headlines. It didn't start with a tweet. And it definitely didn't start when the price broke $70,000. It started long before that. It started the moment trust began to fracture. Trust in governments to control spending. Trust in central banks to manage money. Trust in fiat currency itself to hold value over time. History repeats, not because people forget, but because systems are designed to favor short-term comfort over long-term truth. And the truth is this: we are living through the final chapters of the post-Bretton Woods monetary experiment, and Bitcoin. Bitcoin is not the reaction. Bitcoin is the revelation. The world is waking up not all at once, but wave by wave, to the idea that money must be redefined, not by governments, not by corporations, but by code. Every fiat regime ends the same way: debt, denial, and debasement. From Rome's silver denarius to Weimar's papier-mark to the US dollar post-1971, history offers a brutal rhythm. Governments overspend, print to cover the gap, inflate away the consequence, and pass the bill to the future, until the future refuses to pay. This isn't conspiracy, it's accounting. Peter Drucker once warned, the greatest danger in times of turbulence is not the turbulence, it is to act with yesterday's logic. And yet here we are, watching. Policymakers treat trillion-dollar deficits like rounding errors, watching real wages stagnate while asset bubbles inflate, watching liquidity injections dress up as stimulus while real productivity declines. Bitcoin surges because the illusion is cracking. When the Federal Reserve added more to its balance sheet in a single year than in the entire 2008 financial crisis, markets didn't blink. They rallied. Why? Because they've learned the game. Liquidity flows first to speculation, then to inflation, then to revolt. Bitcoin is that revolt, not with violence, but with protocol, not with protest, but with exit. It is the digital defection of capital away from the broken logic of inflationary monetary policy. The melt up isn't just a market phase, it's a psychological regime. Daniel Kahneman taught us that the human brain prefers certainty, even if it's an illusion, over the discomfort of uncertainty. So when money is printed, assets rise, and volatility drops, the brain doesn't question it, it celebrates it. But melt-ups have a cruel paradox. The higher the market climbs on artificial liquidity, the more fragile it becomes when that liquidity tightens. And here's the rub. Central banks are trapped. Raise rates, debt implodes, lower rates. Inflation surges, so what do? They bluff. They tighten just enough to seem serious, but not enough to break the machine. Meanwhile, behind the curtain, shadow liquidity pours in through repo markets, swap lines, and emergency backstops. Bitcoin doesn't surge because people suddenly believe in it. Bitcoin surges because the system that was designed to contain it no longer contains itself. At $1, it was a toy. At $100, it was a gamble. At $1,000, it was a bubble. At $10,000, it was a threat. At $70,000, it's a paradigm shift. Markets are not just numbers, they are mirrors. They reflect how a civilization feels about its future. And right now, Bitcoin reflects a world that no longer believes its currencies are safe. Yuval Noah Harari once described human history as a series of shared myths that bind us. Money is one of the most powerful myths ever created, a story everyone agrees to believe. But what happens when that story frays? You look for a new one. Not perfect, not without risk, but one that can't be rewritten by political agendas or election cycles. Bitcoin is not rising because it's trendy. It's rising because it represents the one thing fiat currency can no longer offer: trust through incorruptibility. Every major asset cycle ends in disillusionment. But before that, it offers the bold a once-in-a-generation opportunity. This is not 2017. This is not 2021. This is 2025, and the game has changed. Retail investors are no longer early. Institutions are no longer skeptical. Nations are no longer dismissive. You are not witnessing the beginning of a bubble. You are witnessing the beginning of a bidding war. Hedge funds are front-running treasuries. Sovereign wealth funds are accumulating cold storage wallets. Public companies are reshaping their balance sheets around digital scarcity. Why? Because the asset that was mocked for being too volatile is now seen as the only escape valve from the volatility of sovereign irresponsibility. And the crowd? Still watching the headlines, still reacting to ETF approvals and celebrity tweets, still mistaking noise for signal. But the smart money, the Drucker class of strategic thinkers, they've already moved. Because they understand, the real value of an asset isn't what it does today, but what it protects you from tomorrow. Václav Smil warned that the greatest threats to a society come not from external shocks, but from systemic inefficiencies left unchallenged. That's what we're living through right now. A world addicted to credit, a global economy built on phantom growth, a financial system where expansion is the only way to avoid collapse. And what's the solution? Tighten, you crash growth. Ease, you kill purchasing power. What's left? Alternative systems. Bitcoin is not an investment in price, it is a hedge against paradigm decay. It is insurance against fiat collapse. It is exposure to a monetary system where rules matter more than rulers. Where ownership isn't a function of jurisdiction, but of mathematics. This is the macro case for Bitcoin. It doesn't just move with markets. It moves because of markets that no longer make sense. Here's what the data says. M2 growth is still outpacing real GDP in multiple G20 nations. Real interest rates remain negative once adjusted for sticky inflation categories like housing, insurance, and healthcare. Currency devaluation is accelerating in emerging markets faster than at any time since the late 90s. This is where capital flows not to yield, but to survival. Bitcoin, gold, energy equities, commodities with inelastic demand curves. But Bitcoin leads because of one reason: portability of trust. You can store it, move it, collateralize it, borrow against it, and validate it, without asking anyone's permission. It is not just an asset, it is a financial passport. Mariana Mazzucato tells us that value isn't just created, it's chosen. It's defined by where capital flows when capital needs safety and conviction. So ask yourself, where will capital flow when nation-states fight over debt ceilings? When central banks toggle between inflation and stagnation? When geopolitical tensions threaten supply chains and AI displaces millions? It will not flow to promises. It will flow to proof. Proof of scarcity. Proof of decentralization. Proof of time-tested code. And Bitcoin, with every halving, every node, every block, continues to prove what no fiat currency ever has: that monetary policy can exist outside of politics. Every 4 years, something extraordinary happens. Not in a boardroom, not in a parliament, but in code. The Bitcoin halving is not a reaction. It is not an announcement. It is a pre-programmed law that operates with no regard for emotion, politics, or fear. It cuts the new supply of Bitcoin in half, algorithmically, with the precision of a surgeon. No negotiation, no stimulus, no quantitative easing. Just discipline. Joseph Schumpeter called capitalism a process of creative destruction. Bitcoin is monetary discipline coded into the very DNA of a digital economy. Think about that. While central banks debate interest rates and governments play chess with printing presses, Bitcoin simply moves forward block by block, with a supply curve more predictable than gold, more stable than any fiat benchmark, and more trusted by every miner verifying it in real time. This isn't a speculative gimmick, it's monetary revolution through subtraction. Most people still talk about Bitcoin like it's a tech stock, as if it's a startup with quarterly earnings, competitive risk, and founder exposure. But Bitcoin is not a company. It has no CEO, no board, no roadmap subject to opinion or ideology. What you're looking at is monetary infrastructure, a protocol that functions as both store of value and rail for trustless transfer, globally, instantly, and without intermediaries. Amy Webb would call this a converging inflection, where multiple future trends, distrust and fiat, rise of digital infrastructure, the need for censorship-resistant value, all collide into one breakout point. That point is now. The institutions are realizing it, sovereigns are preparing for it, developers are building on it, and the public? Still distracted by volatility. But volatility is not failure. It is the natural response of a free market discovering truth in real time. And the truth is, Bitcoin is no longer just an asset. It is a network state, digitally sovereign, economically viable, and governed by mathematics, not manipulation. We are entering a new age of geopolitics. Not one defined by tanks or tariffs, but by information, capital, and computation. Ian Bremmer warned us years ago, global power is shifting from nation-states to networks, and Bitcoin is the purest example of this transition. It does not recognize borders. It does not need central permission. and it cannot be silenced through legislation. Governments may regulate its on-ramps, they may tax its exits, but they cannot kill the protocol, because it is everywhere and nowhere all at once. This unnerves the old system. The fiat world depends on control, over issuance, over rates, over surveillance. Bitcoin offers escape, not into chaos but into opt-in order. An order where code replaces committee, where transparency is a feature, not a post-crisis PR campaign, where money cannot be weaponized, only protected, and that, above all, is why it is surging. Because trust in legacy institutions is fading faster than anyone wants to admit, and the people are quietly building a plan B. Let's get brutally honest. Inflation is not an accident. It's not a miscalculation. It's not a temporary oversight. It is policy by design. Fiat currencies are built to debase. That is their function. Milton Friedman warned us decades ago. Inflation is always and everywhere a monetary phenomenon. What's changed is not the cause. What's changed is the speed. Since 2020, more than 40% of all US dollars in existence have been created. Asset prices exploded. Consumer confidence shattered. And still they told you it was transitory. It wasn't. And now, as the cost of groceries rises, as housing becomes unreachable, and as savings are silently eroded, people are waking up to the fiat fallacy. That fallacy is this: that stability comes from central control. In reality, it comes from sound structure, and Bitcoin offers that structure without middlemen, without bias, without moral hazard. It does not promise utopia. But it does offer you an exit from the fiat carousel of inflation, debt, and eventual collapse. When BlackRock files for a Bitcoin ETF, it's not ideology. It's math. When Fidelity opens Bitcoin retirement accounts, it's not rebellion, it's risk management. When sovereign nations explore Bitcoin mining strategies, it's not fringe. It's geostrategic positioning. Behind closed doors, the institutions have already voted. Bitcoin is no longer an idea. It is a balance sheet decision, a treasury hedge, a liquidity option in a world addicted to volatility. And here's what the average investor doesn't see. The float is gone. Bitcoin is being locked up in custody, cold storage, and smart contracts. It's being used as collateral for global trade, settlements, and cross-border lending. This isn't about speculative upside, it's about access. Because the day will come, and it's closer than you think, when buying one Bitcoin will not be a matter of price, but permission. The doors will close quietly, and those who waited for certainty will be priced out not by cost, but by availability. Every 4 years, the world forgets. It forgets how this asset moves. It forgets how conviction is tested in cycles, and it forgets that scarcity is the only real moat in an infinite printing world. Bitcoin doesn't rise because it's trending. It rises because supply is drying up permanently while demand is awakening globally. This is not just an economic truth. It's a philosophical one. Thomas Piketty taught us that inequality widens when capital compounds faster than labor can earn. Bitcoin breaks this trap not by redistributing wealth, but by giving individuals a tool to front-run monetary decay. You don't need permission. You don't need a trust fund. You don't need a political party to validate your choice. You just need time. Time is the great equalizer. And Bitcoin, unlike every fiat currency before it, rewards those who think in decades, not days. This is not the top. This is not the final surge. This is not where it ends. This is where it begins for those with eyes to see. You are living through one of the greatest monetary transitions in human history. A shift from debt-based value to digitally native scarcity. And right now, while the masses scroll, argue, and hesitate, the builders are building, the allocators are accumulating, and the network is strengthening. This is not a moment for indecision. This is not a time for fear. This is the time to think like Drucker, act like Schumpeter, and move like Taleb, with asymmetry in mind and clarity in your gut. Because the future is not something we enter, it's something we shape. And Bitcoin, with all its volatility, with all its imperfections, with all its misunderstood beauty, is the clearest signal in a noisy, fragile financial world that something better is not only possible. It is already being built. A new global chessboard is being drawn, not with armies, but with algorithms. Nations once defined by industrial might are now redefined by computational power and energy economics. The old world order, where currency war was fought through interest rates and quantitative easing, is giving way to mineral war and hash rate diplomacy. China's miners once dominated the network, forging blocks beneath mountains of coal. Now, they face competition from North American renewable projects, Nordic hydroelectric farms, and Middle Eastern solar arrays. Energy resources are the new battleground, because to control Bitcoin's supply curve is to wield financial influence without printing presses. Ian Bremmer foresaw a world of state capitalism, where governments stir the market for strategic advantage. Bitcoin challenges that model. It is the first truly borderless commodity. You can mine it in Iceland's chill winds or Qatar's desert sun. You can safeguard it in Nevada's vaults or Zug's legislative tech hub. In this shifting landscape, alliances form around hash rate, not ideology. Countries once pitted against each other find common ground in hosting nodes and building data centers. Diplomacy is evolving, from embassies to exchange nodes, from trade deals to mining pools. This geopolitical realignment isn't theoretical. It's already unfolding in the airwaves and incentive structures beneath your feet. And if you're tuned into it, you'll see capital flowing toward countries with cheap energy, political certainty, and forward-thinking regulations. Because Bitcoin is sovereign neutral, it doesn't care about passports, only about proof of work. Bitcoin is often called digital gold. But that analogy tells only half the story. Gold is a relic. Heavy, opaque, immobile. Bitcoin, by contrast, is dynamic money. It merges cryptography, distributed consensus, and programmable finance into one unified protocol. Ray Kurzweil spoke of the singularity, a point where technological progress accelerates beyond comprehension. Bitcoin is not the singularity. It is the prelude to a series of singularities in finance, governance, and identity. Smart contracts, layer 2 scaling, decentralized autonomous organizations. Each iteration builds on Bitcoin's base layer, transforming it from simple value transfer into a global settlement network. Imagine a world where cross-border trade uses Bitcoin as the invoicing unit, where remittances bypass SWIFT's fees and delays, where microtransactions power IoT ecosystems and digital scarcity underpins new social contracts in the metaverse. This convergence of capital and code isn't distant. It's happening now. Developers launching sidechains, banks piloting custody solutions, startups integrating Lightning Network for instant payments. And every day that passes, Bitcoin's infrastructure cements its digital sovereignty, making a centralized fiat reboot not just unlikely, but economically irrational. Amidst all this data and code, don't forget, markets are human. They pulse with confidence, fear, hope, and doubt. Amartya Sen taught that development is not just GDP per capita, but the expansion of human capabilities. Bitcoin expands capabilities by giving individuals direct control over their finances, by building a global financial identity for the unbanked, and by enabling trustless exchange across languages and borders. Behind every on-chain address is a story. A remittance worker in Manila sending wages home. A dissident in a repressive state safeguarding savings from seizure. An entrepreneur in Silicon Valley funding the next wave of innovation without KYC delays. Those stories aren't footnotes. They're the foundation of a new economy, one built on permissionless access and inclusion, rather than exclusion by gatekeepers. And in this economy, every individual choice, to buy, hold, or transact, is a vote. A vote for resilience over reliance. A vote for code over corruption. A vote for freedom as a monetary principle. Let's be clear, Bitcoin is volatile. Its cycles are not gentle waves, but seismic shifts. The swings can test the steeliest nerves. But as Nassim Taleb reminds us with his concept of anti-fragility, some systems gain strength from disorder. Bitcoin's architecture doesn't just survive shocks, it adapts to them. Every crash shakes out weak hands and questionable projects. Every rally reinforces the network's security and broadens its base. Each cycle builds resilience into the protocol and conviction into the holder. Smart allocators know, in a world of zero yields and negative real rates, risk isn't in volatility. Risk is in certainty, the belief that today's policies will still hold tomorrow. Bitcoin offers no such false certainty. Instead, it offers asymmetry. Unlimited upside, known fixed supply, and a track record of revival from every prior collapse. Position sizing matters. Dollar cost averaging matters. But above all, conviction matters. Because the biggest risk is not that Bitcoin crashes again. It's that you miss the broader shift while you wait for stability. Thomas Piketty analyzed wealth concentration in the industrial era. He showed how capital accumulation can spiral beyond labor's ability to compete. Bitcoin doesn't erase inequality. But by capping supply and democratizing access, it redefines how value circulates. Picture an economy where value isn't trapped in the hands of the few. Where wealth isn't bound by geography or lineage. Where innovative ideas can be funded by a global crowd in minutes, not gated by venture networks. Don Tapscott saw the potential of blockchain to transform industries, from finance to healthcare to governance. With Bitcoin as the first mover, we're witnessing the demo run. Peer-to-peer lending without banks. Micropayments for content without platforms. Decentralized governance without bureaucracies. These aren't academic exercises. They're blueprints for tomorrow's political economy, one where trust is algorithmic and power is distributed. Money has always carried moral weight. Fiat money carries the moral hazard of bailouts, favoritism, and hidden inflation taxes. Bitcoin carries none of these. It is neutral. It is transparent. It is incorruptible. Klaus Schwab talks about the fourth industrial revolution, where technology blurs boundaries between physical, digital, and biological spheres. Bitcoin is the guardrail in that revolution, a moral compass and code that ensures the digital economy doesn't repeat the moral failures of the past. When every transaction is verifiable, when every unit cannot be created on a whim, we align incentives with integrity. We build systems that reward genuine value creation, not politicking or printing. That ethical positioning is the most underrated driver of Bitcoin's surge. Because deep down, people crave fairness. And no monetary system can survive without it. A true capital allocator does not chase the top or bail at the bottom. They build asymmetry into their allocations, where potential upside far exceeds conceivable downside. Joseph Schumpeter reminded us that economic transformation comes from waves of innovation. Bitcoin is the crest of the latest wave. Riding it requires more than conviction. It demands a portfolio structured for exponential growth. That means core holding, allocate a defined percentage enough to matter, but small enough to weather volatility. Staggered entry. Use systematic buys dollar cost averaging through bear markets and bull markets alike. Risk layering. Pair Bitcoin with complementary assets, real assets, venture stage ideas, and inflation-protected securities. Liquidity buffer. Maintain cash or stable assets for opportunistic purchases when fear peaks. This framework is not guesswork. It mirrors how sovereign wealth funds and endowments think, balancing growth engines with shock absorbers. Because the greatest risk is not price collapses, it's missing the generational transition unfolding now. In traditional markets, transparency is a veneer. Hidden risks reside off balance sheet. On-kind data is different. Every transaction, every wallet age, every concentration can be measured. Exchange reserves. Declining balances signal accumulation. Whale movements. Big transfers at low volatility hint at novice buying, not distribution. Network health. Active addresses and hash rate growth reflect rising adoption and security. Realized price bands. The majority cost basis of holders defines support and resistance. These signals aren't trivial. They are the pulse of a living monetary network, and they tell the story that prices alone cannot. A dramatic departure from opaque markets. Bitcoin gives you real-time macro-quantitative clarity that once would have been entrusted to insider boards and confidential briefings. Imagine logging into a world where loans are underwritten by code, not credit scores. Insurance payouts settle through oracles and smart contracts within milliseconds. Cross-border payroll disperses in programmable installments, adapting to currency shocks in real time. Sovereign debt auctions take place in open, verifiable ledgers, eliminating hidden fees and political backroom deals. That ecosystem is not science fiction. It is emerging now, woven into Bitcoin's architecture and layered solutions. Banks may still exist, but they will evolve into service providers rather than sovereign. Issuers, custodians of digital assets, gateways for on-kind finance, and curators of infrastructure. For forward thinkers, this means reimagining your role. From investor in proprietary products to operator of protocols to stakeholder in decentralized networks. Because value creation in this new environment doesn't come from creating scarcity, Bitcoin handles that. It comes from building utility, governance, and user experiences on top of a sound monetary base. Every major shift in economic history was preceded by a transformative idea copying, adapting, sometimes overthrowing what came before. Drucker taught us that decision-making under uncertainty defines leadership. Keynes showed how sentiment and animal spirits can dominate fundamentals. Friedman cautioned against monetary discretion. Sen emphasized human capabilities over mechanical metrics. Harari chronicled the power of shared myths. Bitcoin synthesizes these insights. A monetary policy free of human discretion echoing Friedman. A narrative powerful enough to shift human belief and mass echoing Harari. A system that empowers individuals echoing Sen. A phenomenon driven by confidence just as much as by capital flows echoing Keynes. A disciplined, decentralized decision-making process echoing Drucker. You stand at the crossroads of these intellectual legacies. Your task is not to rediscover them, but to act upon them through the lens of digital money. Close your eyes and picture the world in 2030. A freelance engineer in Lagos contracts with a startup in Berlin, settled instantly in a programmable stablecoin, collateralized by Bitcoin. A retiree in Madrid protects savings from local currency erosion, while earning yield through liquidity pools. A community in Southeast Asia funds a renewable microgrid through a tokenized cooperative, underpinned by trust-minimized finance. This is not utopia. It is possibility, the world that Bitcoin's existence enables layer by layer, cycle by cycle. And vision without execution is vanity, so let your mantra be this. Think in decades, allocate with discipline, act with conviction. Because Bitcoin's real power lies not in price predictions, but in shaping choice, the choice to opt out of monetary decay, the choice to reforge financial identity, and the choice to harness technology for human progress. Feel the weight of this moment. The weight of trillions in global reserves teetering on policy cliffs. The weight of billions of people yearning for stability in their daily lives. The weight of a network engineered to withstand every test of authority. This surge is not ephemeral. It is the awakening of a new monetary era, a call to arms not with weapons, but with wallets. Not with violence, but with code. Not with despair, but with deep-seated belief in a technology that refuses to be controlled. The question is no longer, will Bitcoin survive? It is, will you survive without it? The answer lies in your next move. Your conviction, your allocation, your readiness to navigate the age of digital money. The new monetary cycle has already begun. Are you ready?